Good morning, guys. Matt from Blaze Capital here. So today I just want to go over a couple indicators with you guys. We're going to go over the moving averages and the Bollinger Bands. Originally I was going to do about 4 or 5 indicators, but I think I'm going to split them up into some smaller videos so that they're easier to manage. I also have to go to my mom's birthday today, so I'm going to keep this one pretty short. Okay, so first thing, there's two different kind of moving averages. We have the simple moving average and the exponential moving average. The simple moving average is calculated just by adding the amount of days, like the amount of prices, closing prices by the day. So if you have 10 of them, so you're going to add the 10 together, then divide by 10, whereas the exponential moving average has a little bit more complicated equation. It's takes the current price minus the previous price times a multiplier and then add the previous moving average. So this tends to smooth out the price action a little bit. So most people use the simple moving average for larger time periods. So like the daily, for example, which I have on my screen here. So we have the 50-day moving average, 100-day, and 200. People use all kinds of different different day amounts, but you just kind of have to find what works for you. So what do we have here? This is called a death cross when the lower moving average crosses over the larger moving average. And then conversely, when we have it coming back up the other way, this is called the golden cross. So you will see that a lot on Twitter, or if you're on social media, people talk about that a lot. So that's what they're referring to, is when one of these moving averages crosses up above the other one or below for a death cross. So this is just the S&P 500 here. So this is how we kind of determine if things are going to be more bearish or more bullish. So as you can see here, we had one golden cross here, and it's almost crossing over the 200 right here, which would be more bullish, but we'll have to see what happens this week after that big ugly candle right there. So I primarily use the exponential moving average. I do more short period time frames. So on the 5-minute, that's all I use is the 5 and the 10-day moving average. Some people use the 8 and the 21. You'll see 12 and 26, like whatever. It all comes down to what you can get replicating good results from. So it's kind of personal preference. So that's what I use. So there's the simple moving averages there. We're going to go into some shorter time frames and look at those. So this is 5-minute chart from the S&P 500. So Friday, for example, you just have to follow rules. So the price was pretty bearish all day. It couldn't get over top of the 10-day moving average all day. So just kind of got rejected, got rejected, got rejected, got rejected, got rejected. And then right here, we finally get a moving average cross. So the 5 crossed over the 10, which is bullish. So if you would have just waited for that all day and didn't try and go long here, that would have saved you a lot of heartache, because it was pretty ugly on Friday. So even if you bought here at 280.5, sold here, if you're playing options, that's probably like on 10 contracts, that would be like almost a $300 move, which is pretty solid. And then down here, bearish, and then at the end of the day here, we got another cross up here, and then you would have caught a pretty nice move, about $1.25 move from there. So I like the moving averages just for the purpose of determining if something's bullish or bearish. So like on Thursday, for example, we had a moving average cross here. It was over top of the 5-day and the 10-day all day pretty much, which was pretty bullish. So if you would have just did nothing else but buy here, 281.85, you would have been able to ride that all the way up. If you caught the entire move, that's not realistic, but so that would have been about a $3 move almost, $2.50. And then we had a downward cross here, and then we had another pretty nice move at the end of the day. So that's just kind of one way to use the moving averages. I like the 5-10 cross, that's my favorite. We can also use these on the daily time frame. So if you were just following these here in October, if you had just sold, if you had some longer term stuff and you just sold here, you would have saved yourself 290 down to probably somewhere around 265. You're not gonna catch the whole move every time. That's not realistic. So, but if you would have saved yourself all of that loss all the way down here, and then bought here, sold here, because we kept hitting resistance up around here. So there you go. And then in January, we had another moving average cross here. You could ride that all the way up here. Boom. So that's just a couple ways to use the moving averages. Again, when it's reasonably bullish when we're over top of these blue and red lines, and then bearish underneath those red and blue lines. If we take a little more volatile stock, so Aurora's been pretty choppy lately. So this is the 5-minute time frame. So the last few days it's been extremely choppy. The moving averages aren't always going to work 100% for you. So like here, for example, they like tank price all the way down here. And then we didn't get a moving average cross till, how high is that? $1.50 higher almost, till we got a moving average cross, and then it just got rejected, came back all the way down here. So again, all this stuff is just tools for us to use, but for quick summary, we're pretty bearish below the 5 and the 10 moving average on each time frame, and then when we're above the 5 and 10 moving average, that's pretty bullish. And if you did nothing but wait for those, you'd have pretty good success. There. All right, so there's moving averages. Sometimes act as resistance and support. I tend to use them more as when the one crosses over the other or downwards for shorter term plays. The second thing I wanted to go over is how to use Bollinger Bands. So there we go. So we have Bollinger Bands here. This is 2 standard deviations away, and this is 3. So what the standard deviation means is the distance away from the 20-day simple moving average, which is this brown line that runs through the middle. 90% of price action stays in between these 2 bands here. And then I couldn't find the exact percentage, but it's in the high 90% stays within these, the 3 standard deviations, which is the second line here. So the S&P follows the moving average, or the Bollinger Bands very, very closely. It's a very good indicator if something's overbought or oversold. However, we're not always going to be able to use a Bollinger Bands. So for example, this was when we were dumping really hard in October. So this was outside the Bollinger Band for quite a while. Like, that's a really big drop. So how many? That was $9 or $10, and then we had another $8 before we started getting any any short-term bounce. So that's where you have to use some of the other indicators. We're going to go over some of the strength indicators next weekend. So this is how you kind of combine all this information together. Same as here, like it was outside Bollinger Band, Bollinger Band, Bollinger Band, Bollinger Band. So just kind of tanked. So that's why we can't necessarily use the Bollinger Band as 100%. It's going to come back in, but again, 90% of the price action stays within the Bollinger Bands. The key takeaway here is we want to wait for confirmation of a bounce. So what that means is we're going to wait for the price of the following bar to go back into the Bollinger Bands before we buy, because you can see it just keeps dumping. So like here, for example, tanked way outside the Bollinger Band, and then this one went all the way down to the 3rd standard deviation, and then we would want to wait until it goes back above the closing price of this one before even looking at getting back in, because it could have just kept tanking here. Same as here, this one tanked way down here, and then we would want to wait until we get some confirmation of going back up. It also works on the upside. So when you see any of these crazy momentum stocks going crazy, and then we 9 times out of 10 don't want to buy those unless you're just straight gambling with some money you can afford to lose. So my favorite example is Tilray. So if we go to the daily chart here, it's riding the Bollinger Band, and then we had a massive overshoot where it went from $150 all the way up to $300. And as you can see here, it's way outside of the Bollinger Band. So you would never want to buy up here. Like, you just wouldn't. You're not going to get a good risk-reward ratio. And again, your percentages, 90% is going to come back into the Bollinger Bands. So what happened the following day? We came all the way back down. We went from 300 down to 170, 171, 174, 174. So just not a good risk-reward ratio here. Same as the, what was it called? Biopath Holdings. This one just went skyrocketed, went from $2 all the way up to 70. Again, you just would not want to buy here. It's the risk reward's not worth it. So comes all the way back in. There, you can look at these on any of those crazy momentum ones. Shrimp was it called? Same thing. Outside the Bollinger Band, came all the way back in. And when you get a crazy parabola like this, most of the time it's going to come back and do a 50% retracement. So we went up to 94 cents. Where did it come back down to? Somewhere, it went all the way down to 20. This was much bigger than 50%, but for argument's sake, most of the time you're going to get at least a 50% retracement. The other one, MBOT, we went from $2.59 to $20. What happened? Come all the way back down, back into the Bollinger Bands, and then get some consolidation. So we went from $19 down to $8, so that was again more than a 50% pullback. So this tool is just useful for determining like risk reward ratios. So Aurora, if we go back here, they tanked the price down to outside the Bollinger Band. This is on the 5-minute chart on Friday. So we get a massive hammer here, back test support. So this reasonably would be a pretty good low risk trade here. You're way outside the Bollinger Band. You hit support from back here. So we pulled the support from all the way back there. Oh, sorry, wrong one. Back here. So 1196. So you'd have a pretty low risk trade. You could buy somewhere around here, put in a stop loss, and then you would have caught $12 to $12.30. So like a 30-cent move. So that's their favorite play on MJ. They love tanking the price down and then having it go up. So this is a scenario where we can combine our indicators together, where we just went over the moving averages and then the Bollinger Bands. So here, again, they tank it down here, have a pretty good ramp. And then, so if you bought down here and outside the Bollinger Band, you would sell when the moving average, when it goes back under the moving averages here, and then it just kind of rode, it rode underneath the 10-day most of the day again. Conversely, we don't generally like buying gap ups. Same reason. So Aurora here gapped up outside of the Bollinger Band and then had a massive bearish engulfing candle, came all the way back down and there. So when we get a gap up, we typically want it to come up and then come back in, test the 5 or the 10-day and move up. I'll go back to the S&P for a good example of one of those. Yeah, so here, comes outside the Bollinger Band, came back down here, stayed above the moving average, came back down, came back up. So we just like don't want to buy the gap ups. Usually they usually pull back to support, or the S&P likes to go back and fill the gaps too. So where's another example? yeah, so here, gap up, you want it to go sideways, and then here it hit the 5-day moving average, and then just kind of rode all the way up. So that's a good buy, but there's other times where we'll gap up and then fill the gap. It's been pretty bullish for the last while, so we're having a hard time showing a good example here. There, okay, there, that's what I was looking for. So here we had a gap up, sank all day because we had to fill this gap here, and then continued upwards. So that happens quite frequently as well. So it's just basically all this stuff, there's three or four outcomes. So when we have a gap up, we're either gonna sink back, gap fill, we're going to sink and then continue downwards. So if we look at this one over here, gap up, sink, filled the gap, kept going down, or we're going to get the continuation one where we gap up and then ride the Bollinger Band, or sorry, the moving average up. So this one here is a good example. We'll gap up, come in to test the moving average, and then continue upwards. So that's the three scenarios for a gap up. Now we need the three scenarios for the gap down. So gap down, we're either going to consolidate sideways, go up, and then there, or we're going to gap down and keep dropping. So here, gap down, sank, stayed under the moving average all day. And then again, like you wouldn't even bother looking at buying this probably until we had a moving average cross, because it's just keep riding. And we want the best low risk trades possible, right guys? And the other option is we get a gap down and then going upwards. So if we can find an example of that. So here, gap down. This was pretty choppy here. So gap down, up, rejected, and then finally went up. All right, so hopefully you guys learned a couple things. I'm sure I left some stuff out, so feel free to ask questions. But this is a start. You kind of just have to find a system that works for you. So my system, I generally look for the Bollinger Bands to get pierced one way or the other for a buy or a sell, and then I combine those with the moving averages to determine bullish or bearishness. And I use the crosses in order to give myself discipline, because it's very easy to buy before that happens and then have it just keep dropping, as you can see from some of the examples we went over. Awesome. Thanks, guys. Let's make some money. Have a good weekend.